What's the difference between a bank and a non-bank home loan? There are two main differences. Number one, the type of loans they provide. And number two, where they get the money they lend. This video looks at the differences in home loans. The key difference here is that a non-bank offers a range of home loan options for customers who may not fit bank's criteria. Let's look at how this works. When any lender's looking at a loan application, they look at the risk involved in lending money to a particular customer. Banks typically offer low-risk loans, whereas non-banks consider offering loans for customers that banks consider too high risk. The difference in lending risk is a major factor in how home loan interest rates are set, and a key reason they will vary. Higher risk will usually mean a higher interest rate. The wide range of rates a non-bank offers reflects the wide range of options they have for different types of customer situations. There's a set of things any lender looks at to decide how risky a loan might be. They are called lending criteria. Each lender has policies around each of the different lending criteria they look at. A policy simply details how they will make their decision around a particular situation. This type of overall assessment will be used to decide whether a loan can be offered and at what interest rate. The main types of criteria are LVR, the amount of money somebody has to put into a property, or the value they own in a property if they are refinancing, versus how much they want to borrow, called the loan to value ratio, LVR. The more money a person has saved towards buying a house, or the more they own in a house, the lower the risk. Credit history. A lender will assess a person's likelihood to repay a loan by checking previous credit history. A bank will usually look for a clean credit history, whereas a non-bank generally has loan options for people who've had credit problems, ranging from minor issues through to defaults and judgments. Employment and income. Employment and income are looked at as a way to understand how stable an income is. Banks typically look for standard income and full documentation, whereas non-banks will look at non-standard income types and things like pensions and allowances, and alternative documentation, for example, an accountant's letter. All lenders will look at your financial situation and want to be sure that any planned loan repayments will be able to be comfortably managed within your current circumstances and not create financial hardship. At Pepper Money, we keep it personal. We assess each application on its individual merits. We know that real-life unexpected events can happen to anybody, which is why we look to understand the person and reasons behind the situation as part of a decision-making process. To find out more about non-bank loans, speak to us or talk to your broker.